Mortgage rates just dropped for the second week in a row, and a lot of people are about to get bad advice because of it. Let's decode this together. Here is what happened this week. The average 30-year fixed mortgage rate has fallen to a 4-week low. Freddie Mac, the government-backed agency that tracks mortgage rates every single week, put the 30-year fixed at roughly 6.3%. Some refinance quotes are coming in a little lower than that, right around 6.17 to 6.36%. And the 15-year fixed, which is the version where you pay your house off twice as fast but with a bigger monthly payment, is sitting near 5.55 to 5.65%. So yes, rates eased. But the full picture is more complicated than the headline makes it sound. Here is why rates moved down in the first place. Mortgage rates track closely with the yield on 10-year Treasury bonds, which are basically the interest rate the United States government pays to borrow money for a decade. When investors believe inflation is cooling and the Federal Reserve might cut its own benchmark rate later this year, they push 10-year yields lower, and mortgage rates follow. In plain English, the Federal Reserve is the central bank that sets short-term interest rates for the whole country. So when the Fed signals it might cut, bond traders front-run the move, which pulls longer-term rates like mortgages down before the Fed actually does anything. What you are seeing right now is partly a bet on the future, not a reflection of today's economy. That distinction matters because bets can unwind fast if the next inflation report comes in hotter than expected. Now here is the part nobody is saying out loud. A rate dropping from around 7% down to 6.3% sounds huge if you only look at the numbers. In your wallet, it looks a lot smaller. On a $350,000 mortgage, going from 7% to 6.3% shaves about $165 off your monthly principal and interest payment. That is a couple of grocery runs, give or take. Real money, yes, but not the life-changing move most buyers have been waiting for. Compare that to where rates were 4 years ago. Back in 2021, a $350,000 mortgage at 3% cost about $1,476 a month in principal and interest. That same loan today, at 6.3%, runs roughly $2,164 a month. So we are talking about $688 extra dollars every single month for the exact same house. In a single year, you are paying $8,256 more just to borrow the money. Stretched across the full 30 years of the loan, you are paying more than $200,000 in additional interest. Rates dipping a little does not undo that gap. It barely dents it. This is where the ripple effect gets uncomfortable. Home prices never really came back down from the 2021 to 2022 run-up in most of the country. Inventory is still tight because existing homeowners, the ones sitting on locked-in 3% mortgages, are refusing to sell. Why would they? Their current payment is $1,000 a month cheaper than what any replacement home would cost them. That lack of supply keeps prices high, which means buyers today are dealing with two gut punches at once: higher prices and higher rates. A rate dipping a quarter point does not fix either problem. It softens one of them, slightly. For renters, this matters more than people think. When mortgages get expensive, landlords pass those costs through in higher rents, especially on new leases and renewals. If mortgages ease a little, there is less upward pressure on rent. But rents almost never actually go back down. They just stop climbing as fast. So the signal you should really watch is not whether mortgage rates are falling this week. It is whether rent renewals in your city come in flat for a second year in a row. That is the real early indicator that the housing squeeze is finally loosening for everyone, not just buyers. Okay, quick moment of honesty here. Every financial channel on the internet right now is telling you rates are falling, the window is open, go lock in or refinance today. We are not going to do that because it is not that simple. For most people who bought in the last 2 years, a 6.3% rate is still higher than what they already have. Refinancing into a higher rate is not a deal, it is a downgrade. And refinancing at only a slightly lower rate is not automatically a deal either, because closing costs are brutal. Closing costs on a refi typically run 2 to 5% of the loan amount. On a $350,000 mortgage, that is $7,000 to $17,500 out of pocket just to switch lenders. You have to save at least that much in interest before you even break even. Here is the real-world break-even math. Say your current rate is 7.5%. You owe $350,000, and you can lock in a new rate of 6.3%. Your monthly payment drops by about $283. That sounds great. But if your closing costs are $10,000, it takes you roughly 36 months, 3 full years, just to make that money back. If you plan to move before then, the refinance costs you money instead of saving it. Most people who refi do not actually run this math. They hear a lower rate, and they sign. So what should you actually do this week? If you are a current homeowner, pull up your mortgage statement and write down 2 numbers, your current interest rate and your remaining loan balance. Then, use any free mortgage calculator online, there are dozens of good ones, and run a simple break-even test. Plug in the new rate you could get today, estimate your closing costs at 3% of your remaining balance, and see how many months it takes to recover those costs. If you plan to stay in the house longer than that break-even window, a refi might make sense. Otherwise, keep the rate you have and do not let any lender rush you into a decision you have not done the math on. If you are a buyer, do the same exercise in reverse. Do not shop the headline rate. Shop the full monthly payment, including property taxes, homeowners insurance, and mortgage insurance if you are putting less than 20% down. That full payment is what actually leaves your checking account every month. A lot of first-time buyers get blindsided at closing because they budgeted for the principal and interest number and forgot about the other 3. Property taxes and insurance together can easily add $400 to $800 to what you thought your payment would be. On a stretched budget, that is the difference between comfortable and house poor. One more thing worth checking if you are shopping for a home right now. If your budget can genuinely handle the bigger monthly payment, a 15-year fixed at around 5.6% saves you well over $100,000 in total interest compared to a 30-year loan at 6.3%, even though the monthly bill is a few $100s higher. Most buyers never run that comparison because the 30-year payment is what the lender leads with. Ask for both quotes on purpose and then decide. Here are 3 things to watch over the next few weeks. First, keep an eye on the 10-year Treasury yield. You can pull it up on any finance app in under 10 seconds. If it keeps drifting lower, mortgage rates will likely follow it down. Second, watch for the next Federal Reserve meeting and what they signal about rate cuts. Those signals move mortgage rates even when the Fed does not actually cut anything. And third, if you are actively shopping for a home, track your target listing's price for 60 days. If the listing sits without a price cut, the seller is not desperate and you have very little negotiating room. A listing that drops its price twice means you have real leverage, and that leverage can save you more than a rate drop ever will. So here is the bottom line for this week. Rates coming down is good news in the smallest possible way. Not the deal of the century, not a green light to panic refinance. Think of it as a nudge, not a reset. Treat every mortgage decision like a long-term math problem, not a short-term reaction to a headline. Your future self will thank you for running the numbers twice. Quick reminder, everything we cover on Decoded Money is for educational purposes only. None of this is financial advice, and we're not licensed financial advisors. Before you make any money moves, do your own research and talk to someone who knows your specific situation. If this was useful, hit subscribe. We do this every week. That's the Decode for this week. We'll see you in the next one.